Is it now time to just forget about investing and focus on paying off debt? This decision is so different to just a few years ago, where debt was a lot cheaper, and we're also now coming up to 3 consecutive years of double-digit growth. Let's break it down. This decision is going to be very nuanced and very individual, so let's look at the cases for both sides. Paying off debt is a guaranteed return on your money, compared to investing into the stock market, where returns can vary hugely. Looking at historical data over the last 20 years, the global stock market has averaged just over 10%. The S&P 500 by comparison is just over 12%. But within that time frame, we've seen swings of 30% in either direction. And that's what makes this decision so nuanced. You may look at those stats and think, if I've got debt around 5 or 6%, say it's a mortgage on your house or a car loan, and you know that you can get 10% in the stock market, you may think it's a no-brainer to invest more rather than paying off that debt. And that may be true and that may work out well. But the first point is that those historical returns are not guaranteed, and you've also got to ride out the volatility. How would you feel if in 1 year your investments dropped 30%? Can you ride that out? Have you got a long enough time horizon in order to do so? And that brings us on to the next point, that a lot of this depends on your time horizon and where you are in your investment journey. For example, if you're in your early 20s, it may make more sense to invest more rather than paying off debt, because you've got that long time horizon. You can afford to ride out that volatility. And also, if you compare it to paying off debt, say you're paying off a mortgage, if you're in your early 20s, it's likely you're not going to be in one place for the rest of your life. So if your main goal is to move into a bigger house, and you think that paying off more of your mortgage now is going to mean that you can get a bigger mortgage later down the line, or you're going to get a bigger house, you have to compare that to what potential growth would you have in the stock market, which would also then help you to buy that house later down the line. If you're in your 50s and 60s, then this could be very different, because now you're thinking about how you can reduce your costs in the lead up to retirement. So if you've got that mortgage that's coming towards the end, and you can speed up by a few years and come into retirement mortgage free, then that could be a massive goal. And actually, if you've accumulated wealth over your lifetime in your investments, you may be wanting to de-risk part of your portfolio anyway. A lot of investors, as they get closer to retirement age, start to de-risk their portfolio, moving from equities to bonds or money markets or similar instruments, where you may get yields of around 5 to 7%. But if your mortgages are a similar rate, remember that's a guaranteed return on your money. So that's where it could make more sense to pay off debt rather than continue to invest more. There's also a massive psychological element at play here, and this can be so hard to measure because everyone's so different. It could be that you want the peace of mind, for example, paying off your house, going into retirement, having a mortgage-free house. It could be that you've got a car loan, and again, you want to reduce that debt so you own the car outright. However, if you want to pay the car loan off early, just so you can then go and buy another car, then that's not because of the psychological element, because all you're doing is just replacing one loan with another loan. The same with a house. You may pay off that mortgage early, only to then go and buy a bigger house, get a bigger mortgage, and you repeat the process again. And if that's the case, you're better off looking at what your total return could be. The other thing you've got to take into account is flexibility. Once you've paid money towards a loan, that money is gone. You can't get it back. Compared to if you invested into the stock market, you've always got that flexibility and access to it. It may not be ideal if you have to access it within 6 months or a year after you invested, because it hasn't had that long enough time horizon to grow. But at least you've still got access to that money in an emergency if you needed it. The other thing you may want to consider is where the markets are in terms of cycles. For example, if the market has just crashed 20 or 30%, you could argue that stocks could be seen as relatively cheap. Actually, that's a better time to invest into the stock market rather than paying off debt. On the other side of that, if the stock market has been rallying for consecutive years and price to earnings ratios are starting to get a little bit out of control, a lot of people right now are talking about an AI bubble. I mentioned at the start of the video that we're coming up to 3 consecutive years of double-digit growth, and actually it's going to be close to 20% in each of those years. Then you could make the argument that we're due a little bit of a correction. In that case, you then may want to switch and pay more off debt than continue to invest into a arguably overpriced market. This, of course, is a very active approach, and it's not going to be for everyone. It may be just something worth thinking about. The other thing you may want to think about is where you're going to invest the money, not specifically in which stocks or which funds, but what type of accounts. Is it going to be into a stocks and shares ISA? Is it going to be increasing your workplace pension contributions, or into a SIP, a self-invested personal pension? That's going to determine very much so whether this is going to be worthwhile. For example, say you were lucky enough to get to the point where you'd already maxed out your ISA allowance and you're also making considerable pension contributions. Then if you were to invest more, it would likely be into a general investment account, and then you wouldn't get any tax benefits either on the way in or on the way out. So from that perspective, you've got to take that into account in terms of any investment returns you get. You've got to take off any potential tax. And in that case, that might push you slightly more towards paying off debt rather than investing. And the final point you may want to consider is, by reducing debt, does that change the rate of interest that you pay? For example, with a mortgage, a lot of the time, if you're able to get your loan to value ratio under 60%, you'll likely get an enhanced rate. So if you're around 65 or 70%, then it may make more sense to start focusing on getting that loan to value under that 60%. And then once you are under it, you can then shift back more to investing mindset. So as you can see, this is so individual and so personalized. Everyone's got different time horizons, different risk tolerances. So just because you see a friend or someone you know doing something one way and you're doing it the other way, don't feel that you've made a mistake, because you'll only know in hindsight which was the right way to go. At the end of the day, whichever route you go down, you're going to be improving your net position. And remember, if you get to the point where you do have excess cash to deploy, either in investments or paying off debt, you've done so well to get to that point, so don't stress it too much. I hope you found that useful. Let me know your thoughts down below in the comments, and I'll catch you in the next one.